If you felt gut-punched watching silver crash 41% from $121 to $75 in a week, you're not losing your mind. You're watching something that hasn't happened in over 4 decades. While everyone's asking whether silver is dead, you're asking a different question. The right question. What if this crash wasn't the end of the silver story, but the beginning of something far bigger? Because right now, at 7 in the morning Eastern Time on February 8, 2026, as I'm recording this, silver is trading at $78.52 per ounce. And there's one number buried in the COMEX depository data that tells you everything you need to know about what happens next. I'll show you that number in exactly 4 minutes. But first you need to understand what actually happened last week, because the mainstream explanation is complete garbage. January 30th, 2026 will go down in precious metals history. Silver crashed 31.4% in a single trading session. Not over weeks, not over months. One day. The largest single-day collapse since 1980, when the Hunt brothers' manipulation imploded. Gold dropped 12% the same day. Together they wiped out $7 trillion in value across global markets. The media blamed it on 2 things. President Trump's nomination of Kevin Warsh as Federal Reserve Chair, a known hawk who wants higher interest rates and tighter monetary policy, and the CME Group's 6th margin increase in 3 days. That's the official story. Higher margin requirements meant traders had to put up more collateral to hold their positions. Forced selling cascaded through the market. Leveraged longs got liquidated. Panic set in. By the time the dust settled, silver had fallen from over $100 to $75. My name is JHON AG, and I've been tracking this market through every twist since silver was $30. What I'm about to show you isn't just another rally prediction. It's evidence that this crash did the exact opposite of what it was supposed to do. Here's what nobody's talking about. The crash was supposed to relieve pressure on the physical delivery system. It didn't. According to COMEX depository data released in early February 2026, registered silver inventory, that's the metal actually available for delivery against futures contracts, now stands at just 103 million ounces. Let me put that in context. Open interest, the total number of contracts demanding delivery, sits at 429 million ounces. That means open interest is 416% of available deliverable stock. The normal ratio, 15 to 20%. We're at over 400%. This isn't a market. It's a powder keg with a lit fuse. And here's the part that should terrify anyone short silver. In January 2026, 33 million ounces were withdrawn from COMEX registered inventory in 1 week. That's 26% of the entire registered stockpile. Gone. In 7 days. The price crashed 41%. And people took more metal, not less. Stop for a second. I want you to think about what that means. Price goes down, demand goes up. That's not how normal markets work. When the price of milk crashes, people don't suddenly hoard milk. They buy what they need and move on. But when silver crashed from $121 to $75, registered COMEX inventory kept draining at an accelerating pace. As of February 6, 2026, the registered silver inventory is down 38% since October 2025. And February deliveries in just the first few days nearly matched the entire month of February last year. 19 million ounces delivered already. The March contract, which starts delivery on February 27th, is 10 days away. If open interest stays where it is, something is going to break. And I'll explain exactly what that looks like in a minute. But first I need to show you where this disconnect is most obvious. Shanghai. On February 3, 2026, when COMEX spot silver was trading at around $82 per ounce, physical silver in Shanghai was quoted at $104 per ounce. That's a $22 premium. In some cases, dealers in Shenzhen were quoting $112 per ounce, a $9 premium over Western spot prices. According to Shanghai Futures Exchange data released on February 5, spot silver ingot prices against the TD contract had risen to 3,500 yuan per kilogram, with some suppliers quoting as high as 4,000 yuan per kilo. China is facing a historic physical shortage. They're paying 20 to 30% premiums to get metal. At the same time, the iShares Silver Trust, ticker SLV, saw $3.4 billion in inflows on February 2 alone. That was reported by ETF.com on February 4. Retail investors bought the dip so aggressively that it was one of the largest single-day inflows in SLV's history. While paper silver was getting destroyed, physical buyers were loading the boat. Now here's where I could be completely wrong. If March deliveries collapse, if open interest suddenly drops by 70% in the next 2 weeks, then this thesis falls apart. If Shanghai premiums disappear and Chinese buyers stop paying over spot, then maybe JP Morgan is right. They published a note on January 30th predicting silver will crash back to $50 by the end of 2026. Maybe the COMEX can shuffle metal around, reclassify eligible inventory as registered, and keep this game going another decade. Maybe the 6 margin hikes from the CME were enough to scare out the leveraged speculators, and everything goes back to normal. But I don't think that's what's happening, because there's a pattern here that keeps repeating. And if you've been stacking since before 2020, you've seen it before. Every time silver rallies, they raise margins. Every time physical demand surges, the paper price gets smashed. It happened in 2011, when silver hit $49. It happened during the Reddit squeeze in 2021. And it just happened again on January 30, 2026. The mechanism is always the same: increase margin requirements, force liquidation, suppress price, protect the shorts. But here's the difference this time. The physical market isn't playing along. The gap between paper price and physical premium is widening, not closing. And the people taking delivery aren't flipping the metal back into the market. They're holding it. That's why inventory keeps draining even as price falls. This is the part that gets me frustrated, and I'm going to be blunt here because someone needs to say it. The mainstream narrative is that silver crashed because of fundamentals, because the Fed's going to stay hawkish, because the dollar's too strong. Except the dollar index, the DXY, closed at 97.68 on February 6th. That's down 1% over the past month, and down nearly 10% over the past year. The dollar is weakening, not strengthening. The Federal Reserve held rates at 3.5 to 3.75% on January 28th, exactly where they've been. No change, they're not hiking, they're pausing. So what exactly shifted fundamentally to justify a 41% crash in silver? Nothing shifted fundamentally. What shifted was leverage. CME Group raised margin requirements 6 times in the span of a few days. That's a liquidity event, not a fundamental repricing. And liquidity events in silver have a very specific historical pattern. They create violent corrections followed by explosive rebounds. Because the underlying supply-demand imbalance doesn't go away. You can't print more silver. You can't increase registered COMEX inventory by wishing it into existence. The metal either exists in the vault or it doesn't. And right now, according to data as of early February 2026, there are 103 million ounces registered against 429 million ounces of open interest. The math doesn't work. Let me tell you about someone who saw this coming. Michael Oliver, founder of Momentum Structural Analysis. This is the same guy who predicted the 1987 stock market crash. He's been calling for a massive silver breakout for months. On January 29, 2026, he went on record saying silver could hit $300 to $500 per ounce by summer 2026. Not years from now, this summer. His thesis is based on momentum structure analysis, a method that looks at long-term trend breaks rather than short-term price action. According to Oliver, silver just broke out of a half-century consolidation box, the kind of breakout that historically leads to parabolic moves. And here's the key part. He said the crash we just saw strengthens the structure. It doesn't weaken it. Because it flushed out the weak hands, cleared the leverage, and set up the next leg higher with a cleaner technical foundation. His minimum target is $500, not a hope, not a maybe. A minimum structural target based on momentum analysis. Now, I'm not telling you Michael Oliver is guaranteed to be right. I'm telling you his track record is better than almost anyone on Wall Street, and his analysis is based on structure, not speculation. And when you combine his momentum work with the physical supply data, the inventory drain, the Shanghai premiums, and the open interest imbalance, you start to see a picture that's very different from the doom and gloom narrative the mainstream is pushing. You start to see a market that's separating. Paper silver, the futures contracts and ETFs, trades on sentiment and leverage. Physical silver, the actual metal, trades on supply and scarcity. And for the first time in decades, those two prices are diverging in real time. So what do you do with this information? I'm not a financial advisor. I can't tell you what to buy or sell, but I can tell you what I'm watching. March delivery starts February 27th, 10 days from now. If open interest holds above 400 million ounces and registered inventory stays below 110 million ounces, we're going to see stress. Real stress. Either contracts get rolled forward, which kicks the problem down the road, or deliveries actually happen, which drains inventory further, or something breaks, a default, a cash settlement, a force majeure event. And if that happens, the premium on physical silver is going to explode. We're already seeing $22 premiums in Shanghai. Imagine that gap widening to $30, $40, $50 over spot. Imagine trying to buy an ounce of silver and being told the spot price is $80, but you can't get metal for less than $130. That's not a conspiracy theory. That's what happens when paper and physical decouple. The second thing I'm watching is the Federal Reserve. They held rates steady on January 28th, but they're data dependent. If inflation stays sticky, they might hold rates higher for longer. That's bearish for silver in the short term because it keeps real yields elevated. But if they cut rates even once, that's rocket fuel for precious metals. The market's currently pricing in 2 rate cuts for 2026 according to Fed funds futures. If those cuts happen, and the dollar keeps weakening, gold and silver are going to rip. The gold to silver ratio is currently sitting at 63.75. Historically, that ratio averages around 65 to 70. But in the last decade, it spiked as high as 120 during the 2020 COVID crash. When that ratio compresses, meaning silver outperforms gold, you get explosive moves. If gold is trading at $5,000 per ounce and the ratio compresses to 50, that puts silver at $100. If it compresses to 40, that's $125. And if we get a squeeze scenario where the ratio drops to 30, which has happened historically, you're looking at $166 per ounce. That's not my target. That's just math. Here's the third thing. ETF flows. SLV took in $3.4 billion on February 2nd. That's retail money. Mom and pop investors, the same people who got burned in 2021 are coming back. Why? Because they're watching the same data we are. They're seeing the inventory drain. They're reading about Shanghai premiums. They're hearing analysts like Michael Oliver talk about $500 silver. And they're thinking if I missed the move from $30 to $120, I'm not missing the next leg. That's FOMO, fear of missing out. And FOMO is a powerful force in momentum markets. If retail keeps piling into SLV, that ETF has to buy physical silver to back the shares. That creates more demand. More demand drains supply. More drained supply tightens the market. It's a feedback loop. I missed the bottom in 2023. Silver was trading at $20 and I thought it was going lower. I didn't buy. Cost me 100% gain. I learned something from that mistake. Don't wait for perfect clarity. By the time everyone agrees silver's going to $500, it'll already be at $300. The opportunity is now, when the narrative is messy, when half the analysts are calling for $50 and the other half are calling for $500. That's where the asymmetry lives. Risk-reward. If silver goes to 50, you lose 30% from current levels. If it goes to 500, you make 500%. I'll take that bet every time. So where does this leave us? We've got 10 days until March deliveries. We've got 103 million ounces registered. We've got 429 million ounces of open interest. We've got Shanghai paying $22 premiums. We've got retail flooding into SLV. We've got Michael Oliver calling for $500 by summer. And we've got a Federal Reserve that might cut rates twice this year. If even half of those data points play out the way they're trending, silver isn't going to $50. It's going to triple digits. And if we get a genuine delivery failure on the COMEX, if March turns into a real squeeze, we could see moves that make the $121 high look like a warm-up. This is not financial advice. Do your own research. Check the COMEX inventory reports yourself. Watch the Shanghai premiums. Track open interest. Follow the March delivery data starting February 27th. And ask yourself this. If the crash was supposed to fix the supply problem, why is inventory still draining? Why are premiums still elevated? Why is retail still buying? The answer is simple. The crash didn't fix anything. It just reset the board for the next move. And if history is any guide, that next move is going to be violent. I want to hear from you. Pull up your portfolio right now. What percentage of your net worth is in physical metals? Comment just the number. No explanations. Just the percentage. I'm curious to see where this community actually stands. Are you 5% in? 10%? 50%? All in? Drop the number below. And if you've been stacking since before 2020, comment the old man emoji. If you started stacking after, comment the new emoji. Let's see who the veterans are. One more thing. If you found this breakdown valuable, if you appreciate that I'm giving you the actual data instead of hype, hit the subscribe button. I'll be tracking the March delivery period day by day. When registered inventory drops below 100 million ounces, you'll know about it. When Shanghai premiums hit $30, you'll know about it. When Michael Oliver updates his targets, you'll know about it. This is the most important 2 weeks in the silver market in over 40 years. And I'm not going to let you miss it. Next video drops in 48 hours with the latest COMEX delivery numbers. Until then, stay sharp, stay skeptical, and remember what JHON AG always says. The best time to buy silver was at $20. The second best time is when everyone thinks it's over. We'll see you in 2 days.